Income Tax 2020. Tax software example, itemized deductions, medical and dental expenses. Come in, relax with Income Tax 2020. Here we are in our Lacerte tax software. You don't need the Lacerte tax software in order to follow along, although I do think they have a free 30-day trial, so if you can get a demo version of it to practice with it, that might be useful. We're going to be focusing in here on the Form 1040 and the related Schedule A, jumping back and forth from the data input to the forms so that we can run different scenarios and see the impact of them. The software, of course, helping us to do that a little bit more quickly. We have our starting scenario, that being the filing status of single. Eric Smith, our taxpayer living in Beverly Hills 90210. We have the $100,000 of the W-2 income, the $12,400 of the standard deduction to start off with, and then we have the $87,600 taxable income. Mirroring that then on the equation in our Excel worksheet, $100,000 income, standard deduction $12,400. That gives us the $87,600. Now, we're going to be focusing in on the itemized deductions, specifically medical expenses. So the first thing we have to understand is we have to be in a situation where the itemized deductions will clear the threshold of the standard deduction before they will be applicable. In this case, that being $12,400. In the case of a married individual, it would be all the way up to $24,800 before we would get a benefit. So if I go back to my forms, going back to the Schedule A, which is currently not in use because it's not over the threshold, that's why it's gray over here, we're focusing in on the medical expenses. Now remember, in most circumstances, the medical expenses are not the thing that usually kicks people over to the point where they will be itemizing. Usually, the thing that will put people over is going to be the interest on the home, possibly, and state taxes, possibly these real estate taxes on the home. And then the medical expenses will kind of kick in at that point. Medical expenses are a little bit unusual, however, and just note there could be situations where the medical expenses does push someone over the limit. So if someone has a particular problem, they get in an accident, maybe they need machinery in some way that's going to be medical machinery in some way that's expensive, that might be qualified as a medical expense. Or if you're talking about an elderly individual and they might do changes to their home, specifically for doctor recommended changes in order to deal with medical conditions, then those could be costly things that could push people over. So you want to be aware of those types of things if someone has a medical issue in some way and if there's going to be a substantial cost related to them. But normally the medical expenses aren't the thing that will push most people over the threshold to be itemizing. So the other thing that's a little bit funny about medical expenses is that as people get more income, they're more likely to itemize, meaning as people's income goes up, they're probably going to have paying more state taxes, and which are deductible, being more likely to itemize, and they'll probably have interest on the home, being more likely to itemize. So their likelihood to itemize will go up as income goes up, and that would mean that any medical expenses that you could deduct would be beneficial if you're already itemizing. However, as income goes up, you also have a threshold, which is a floor, which is a little bit more unusual. Usually we see caps as income goes up, they cap how much you can deduct. In this case, we have a floor, meaning we have 7.5% of the AGI that you have to clear before you get any benefit from the itemized deductions. So as people's adjusted gross income goes up, they're probably more likely to itemize due to the factors we discussed, but they're also less likely to be able to get the actual medical expenses because the medical expenses you have to clear not only the ability to itemize itself, the $12,400 standard deduction in this case for a single filer, but also you have to be over the 7.5 floor in order to take advantage of that. So just keep that in mind. It's a little bit unusual type of situation. So if I was, for example, to put in a standard medical, like prescription drugs here, let's say prescription drugs were 1,000 on the prescription drugs, and pull that over to the forms, the 1,000 here is being capped and I'm not getting any benefit of it. So we're not itemizing at all, but I'm not even getting a benefit within the Schedule A. Why? Because it took the 100,000 from the first page of the 1040, that's the adjusted gross income. 7.5% of it is 7,500. That's the floor. I have to have medical expenses that clear the 7,500 before I benefit at all. So then if I see that, if I go back over here and say, okay, what if these added up, I had like 8,000, and I'll just put them in one category for now, and I pulled back over. Now we're above the floor and we get that $500. So we're only getting $500 of the $8,000 that were spent on qualified medical expenses. That then adds up, if I add to the state taxes there, to the $1,560, which of course still isn't over the threshold of the standard deduction here, which is that $12,400. So again, the thing that typically will put people over the threshold, if I go back on over, is what if they had like a large thing on medical expenses? Possibly they have lesser income, and then they had this big medical expense. That could be something that could push them over, or it's quite likely that something else pushes them over, right? You might have something else like the interest on the home. So if we had home mortgage interest of say $12,000, property taxes that we had to pay on the home possibly, and state taxes that we had to pay for income tax or sales tax, then we're going to say, I'll say this is 3.5. That's usually the thing that'll kick over. And so now we're going to say, okay, now we're itemizing here. So now we're itemizing because the total itemized deductions are at $1,760 over the $12,400 for the single filer. So they're over this $12,400. So therefore, we're going to be taking the itemized deductions. These things kicked us over the itemized deduction, and then we added up the medical expenses, and because they were over the 7.5%, $500 over, we got a benefit of the $500 related to the medical expenses. Now, obviously, if the adjusted gross income goes down, meaning if I go back on over here and I say, okay, well, what if the income was lower? I'm going to say, okay, what if this was only $50,000 of income? So I'm going to go back on over. Now we got income. That means on the 1040, we've got an AGI, adjusted gross income, now of the $50,000. If I go then to the Schedule A, now we have a lower threshold, $3,750 to clear, because that's 7.5% of the $50,000. And if we still have the $8,000 medical deductions, which have now increased to the $4,250. So we have kind of like a floor as opposed to a ceiling with this 7.5, which again is a little bit unusual. Usually we see kind of like the ceiling, so you got to get used to kind of the floor thing. You got to clear the floor before you get any of the deduction. Let's put it back up to the 100,000. 100,000. Now the other things that you got to kind of consider with the medical deduction, just in terms of the data input, is that many people have the medical expenses tied to their place of employment. Now, if they're paying, like, say, the premiums on the medical insurance themselves, notice if I go back on over here to Schedule A, what types of things do we have in the category for medical expenses? We got the prescription drugs, doctor, dentist, hospital, and nursing insurance premiums not entered elsewhere. So we got the insurance premiums here that could be something deductible. Oftentimes people have their insurance through their employer, and the question is whether or not the employer paid for it or not. So note that if the employer paid for the insurance, that what would happen is if you go to the W-2, then in box 1 of the W-2, they would already, if they paid for it, they should take care of it on the W-2. Meaning, if it was paid for by the employer and it's something they don't have to include in income, it shouldn't be in box 1, then on the W-2, and you would have already gotten a benefit from it in that case. So instead of taking a deduction, for example, if it's something that would not be included in income, they had already taken it out on the W-2, and they might report it down here. You might see something like a DD on line 12A. So if I put like the DD, which is the cost of employer-sponsored health coverage, and I put something like $5,000 here, then it might be the case then that the employer already reduced the taxable income in box 1. So you can't really take a deduction for those premiums because it's already basically been taken out of income in that case. So in that case, we'd go back on over and say there's no change here. It's still $8,000 in that case on the W-2 side of things. Now, if you paid for it, if you paid for the insurance and it's something that was included on box 1, right? It's something that you didn't get a reduction in box 1, the taxable income on the W-2, and you paid for then insurance, then it's possible that you might get a deduction for it. You might be able to then include it here in the insurance premiums and put that $5,000 here, and that would then take you up. Now we're at the 13. the 13,000. So there's often that kind of confusion with, okay, if you have insurance by the employer, did the employer pay for the insurance or did you pay for the insurance? And oftentimes for reporting purposes, the employer is required to put in that in box 12 on the W-2, and you can look at the instructions related to the W-2 related to that. The other thing that could be included here is that we might say that someone is, let's say they're a Schedule C or have a Schedule C type business, and let's say they don't have their insurance through work, and let's say they got a Schedule C business as well. I'll just add that on here, and we're going to say Schedule C business, and let's say they earn 50,000 on the Schedule C. So 50,000 on the Schedule C. This is their own business income now. So now we have a Schedule C, 50,000. That's feeding into line the 1040. So now our taxable income has gone up. And let's say they paid for their own insurance, and so they don't have access to coverage through their W-2 income, but they pay for their own insurance. We talked about in a prior presentation, then you might be able to deduct that on the adjustments to income here. So an above the line deduction. In other words, people may not need, you may not be able to itemize. You may not have to itemize to get a benefit from the insurance if you're self-employed. So then you'd say, okay, self-employed insurance. I'm going to jump to that. And I'm going to say, okay, self-employed insurance. And let's put that 5,000 here. So I'm going to say 5,000 here. And then jump on back over. So now you're taking that deduction as an above the line deduction up here. And therefore you can't really take it on the Schedule A. So the Schedule A is back to that 8,000 for the drugs and stuff that we put in there. So that's why the insurance premiums could be through the work. They could be paid by the work, or maybe you paid for them. Or if you don't have any insurance through the work and you have a business, then you might be able to deduct it on the Schedule C. But if you don't, not on the Schedule C, but on the Schedule 1 related to the Schedule C business, and then you can't deduct it here too, because then you'd be double dipping at that point. You'd have an above the line and below the line deduction for the same thing. So let's go and let's say, well, what if the Schedule C had basically net income lower than the premiums we paid? So what if I had expenses on the Schedule C, for example? I had expenses on the Schedule C, and we're gonna say now Schedule C, and I had like expenses that were like 47,000. So that means my income, if I go back on up to the Schedule C, is only bottom line 3,000. But I paid, what did I say, 5,000? So if I go back to Schedule 1 for the insurance, they limited me on the health insurance now. Due to this worksheet, they limited me on the health insurance. Then the difference, possibly, this is my above the line deduction, they're not going to let me go into the negative territory due to the self-employed health insurance. But if I don't take it there and I paid for it, then maybe the difference should be going over to the Schedule A. And so you could see the Schedule A has now been increased from that 8,000 by the difference in the insurance. So now I took part of the insurance on the above the line deduction, the part that I could, until it took my Schedule C income to 0, and then the rest of it, the software pulled over into here to take any remaining benefit I could get on this side. Okay, so let's remove that scenario. I'm going to say, all right, that's interesting. Let's remove this, remove that. Other scenario, we could say, let's go back to the Schedule A, or I want to go to the adjustments. I want to remove this adjustment. So now we're back to, let's just check out where we're standing right now. We're back to on the 1040, the 100,000 income. We've got the 17,016 in the Schedule A. So Schedule A, we have the 8,000 up top. Now let's say someone is getting Social Security, and they're getting paid Social Security now. Now they're receiving Social Security. So that would mean they're possibly older. So I'm just gonna change the year here. Let's just change the date of birth to 51, and then I'm going to say that they're receiving Social Security benefits. So they're getting Social Security benefits, and you get an indication, a 1099 from the government saying, hey, they got Social Security benefits. And we're going to say, okay, Social Security benefits. And so then I'm going to put here, let's say they got like, I don't know, 10,000 Social Security benefits, and I'll say 2,000 on the Medicare premiums paid. So oftentimes you're going to have this Medicare premiums paid, which will be on the 1099. Now, if I go back over to the forms then, notice that 2,000 was included here. They included that in here as well. So when you have that Social Security benefits, then that'll be included in here typically as well. Okay, so let's go back on over. And let's go back and let's remove that one. That's interesting scenario. Very interesting. Let's bring it back, bring our taxpayer back to being a younger payer here. And we'll bring this back to, let's say, just 77. And so now we're back on over. So now we're back to the 8,000. Now, the other thing just to note is the Medicare taxes that you pay out of your W-2 wages. So, for example, if I go back on over here, wages, the Medicare taxes, that $1,400, that's not being included. So, for example, if I change my wages up to $150,000 and my Medicare wages to $150,000, that $2,750, that's not changing. That's not changing this number. So that's not something that's going to be included as possibly deductible, the amount that you pay to Medicare for Social Security, because that's thought of as a welfare program, not as basically insurance payments there. So there is that. And then if I go back on over and let's change this back to 100,000, back to our base of 100,000. And now let's just kind of review what's on the Schedule A. Prescription drugs, doctors, dentists, hospital and nursing, insurance premiums, long-term care, premiums not entered elsewhere, and then lodging and transportation information, out-of-pocket expenses, and the medical miles driven. This one's going to help us to calculate the actual miles. So if you have the number of miles driven in order for a doctor that are qualified miles for a doctor visit or something, so you drove 100 miles to do something for doctor related, then it'll help you do that calculation, and they did the calculation for you for the 17 cents. So it's going to use like a mileage method on that as well. So you could track, the number of miles you drove and use a mileage method. Although the rate is fairly small, it's a smaller rate. Like they're not updating it like they do with the mileage rate for the Schedule C. So you don't get as much a benefit from it, but it is what it is. Okay, so then if we add these up, note these are totaling up to the 1760 now, and we're only getting a benefit from the medical of that 500. Now just realize that if we were then to get married here, then we wouldn't get any benefit at this point, right? If I went and changed this and said, well, what if Eric got married again? Eric got married again to Jane, and then we're going to go back to the forms. And now the Schedule A is gone because now we're taking the itemized deduction because the standard deduction, because it is now over the 24,800. Okay, so then if I go back to single, let's go back to single. I'm going to say, all right, let's get unmarried again because I want to look at the itemized deductions. So unmarried, back to single, Eric's single again. So there we have it. Now, if you were to enter this in our worksheet, then I would take the same information and put it into the itemized worksheet from the source document as much as possible. So we'd be saying, okay, source document says that we had 8,000 of payments, right? 8,000 of payments. And then the worksheet can kind of help you out with that calculation for the AGI, and there's the calculation for the 500. So this worksheet's basically doing that. The threshold calculation. For the taxes, then if we had taxes and whatnot, we can calculate the taxes that we paid for the real estate taxes. It might be on the 1098, it might not. We might have more documentation for it, but we'd put that there. We'd put 3,500. What I couldn't really get without the software is the calculation of the state income tax typically. So, and I'd have to get that from the software because I'm dependent on the software to calculate the progressive tax system, which California has for state taxes. So I'd have to pull this from the software, 1060, And then we've got the interest on the home. Again, I would get this from the 1098, not from the tax software. So we'd say that was 12,000, and then that's going to add up to that 1760. So that's going to add up to 1760. That then should pull over, and I'm going to put the formula in now. I deleted it so we didn't get confused when we're looking at the standard deduction. But if I pull over that formula, now this formula is taking the greater of the itemized or standard deduction, which of course the itemized is greater now. So that's pulling over here. And we're going to then have the taxable income of the 8290. So if I go to page 1, we've got the taxable 8290. So you can see how this worksheet, again, kind of helps you to do it. You can even have this worksheet be done separately by 2 individuals. If you have an office, you could say, hey, here's the source document for you. You put it into the tax return. Here's the source document for you. You put it into the tax, formula, and then we'll merge the 2 together and put in the things that have limits and whatnot, that are the confusing parts, so we can kind of double check them separately with 2 different people checking it, and then add in things like the state tax that we need to be calculating for, and so on. So that's a kind of internal control that can be used.